Let's now turn our attention to the third important financial statement, the statement of cash flows. In general, corporations prefer to use the accrual method of accounting, and the statement of cash flows serves the purpose of emphasizing the importance of cash to the continuing operations of a business. What the statement of cash flows does essentially is it reconciles the accrual basis income statement to the cash flows that have occurred for the firm over the course of the same period of time. The accrual method obviously has some important advantages. From an accounting perspective, it matches revenues and expenses in the period in which those revenues and expenses occur. Having said that, there's a disadvantage to the accrual method of accounting, and that disadvantage hinges on the fact that a company has to have adequate cash flow to maintain its operations. Companies have gone out of business because they were earning a profit, but on an accrual basis, but had inadequate cash to meet payroll or to make other payments as they came due. So it's of importance, critical importance, that there be adequate cash flow in the firm, as well as in the long run a profitable enterprise. The basic concept behind the cash flow statements, there are three sections of the statement of cash flows. The first involves cash flows from operating activities, and those operating activities come from funds that are generated through normal operations of the firm, and likewise expenses that occur through the normal day-to-day activities of the firm. The second section of the statement of cash flows reflects cash from investing activities, and by investing activities we mean, for example, the purchase of plant and equipment or purchase of other long-term assets. Likewise, those require the expenditure of cash. Likewise, when we sell plant or equipment, or we sell these other assets, that generates cash. So the investing activity section of the statement of cash flows essentially just summarizes what assets, long-term assets, have been acquired or disposed of over the course of the year. We'll say year, could be whatever period of time we're using. The third section is the cash flows from financing activities, and essentially here we're looking at payments of capital to bondholders or to stockholders, or if we raise money from bondholders or stockholders, that's going to be reflected as well in the cash flows from financing activities. When all of these three are added together, we get the we get the increase in total cash, and we've reconciled net income to total cash. The cash flows from operating activities are the first item, and here we're translating income from accrual to a cash basis. There are two ways we can do this. One is the direct method, where every item on the income statement is adjusted to cash method accounting. This is perfectly acceptable but relatively rare. The more common methodology that's used is the indirect method, where we start with net income as the starting point, and then we make adjustments, principally because of changes in balance sheet accounts. We make adjustments to the net income to come to changes in cash. So let's look over the basic methodology with the indirect method. We're going to start with net income, and then because depreciation is not a cash flow, but it is included in net income, we add back depreciation. Depreciation has been deducted by the accountants. In order to reflect cash, we need to add back that depreciation. The next step is to look at changes in current assets, and those can occur either as increases in current assets or decreases in current assets. To the extent that there's an increase in current assets, and let's take, for example, accounts receivable. If we have increasing accounts receivable, that money has not yet been converted into cash. As we make collections on accounts receivable, the accounts receivable will decline, but our cash balances will go up. So increases in accounts receivable are uses of cash, whereas a decrease in accounts receivable is a source of cash. So that's what's true of accounts receivable is true for all of the current assets. Increases in current assets require cash. As we convert those current assets to cash, the current asset balances decline, and we have a decrease in current assets. We also have increases in current liabilities. Increases in current liabilities increase cash. Now, that may not be obvious at first, but when you take a moment to think about it, it's pretty clear that that would need to be the case. If you go out and borrow money, you get cash and you have a liability. So increasing a liability, the reason that liability is increasing is because you're obtaining cash in the process. So increases in liabilities increase cash, but decreases in liabilities require that we have cash because we're paying off a liability. All of that together, as we go through all of those steps, moving from net income, adding back depreciation, then making adjustments for changes in current assets and current liabilities, all of those things together bring us to the net cash flow from operating activities. Let's take a moment to review the balance sheet for Kramer Corporation. What we're interested in this balance sheet that is going to affect specifically the operating cash flows are the current assets right here and the current liability sections. So, for example, let's take accounts receivable. We see that accounts receivable rose from 170 to 200 during the year. Given that the accounts receivable have increased by $30,000, that's going to be a use of funds, and so it's going to reduce cash flows. So let's see how our operating activities are reflected in the statement of cash flows. We start out with net income from the income statement right here. The next thing we do is we add back depreciation, and then we make adjustments for all of the short-term, the current assets and the current liabilities, the changes that have occurred in current assets and current liabilities. So, as we mentioned before, our accounts receivable went up by $30,000, and that requires us to use cash of $30,000. When we collect it, we'll obtain cash of $30,000. So our increase in accounts receivable reduces our cash flow by $30,000. Likewise, if we went back to the balance sheet, we'd see that inventory rose by $20,000. And so here we have a use of cash of $20,000 for inventory. The prepaid expenses, which are also an asset, declined. So now we have an increase in cash flows from that source. On the other hand, these last two items represent current liabilities. There's been an increase in accounts payable, so we haven't had to expend that cash yet. We just owe it. We owe $35,000. And accrued expenses decreased by $5,000. The sum of all these together, $40,000, we can reconcile net income to net cash flows from operating activities right here. So our cash flows from our operating activities were greater than our net income was. That's not unusual, principally because depreciation is always a positive, and you see here that it's the amount of depreciation we took is fairly close to the total adjustments that occurred. That need not always be the case, but depreciation always increases our cash flows from operating activities. The next cash flow adjustments that we have are related to cash flows from investing activities. Let's return for a moment to our balance sheet and note on the balance sheet the long-term investments that we have, which show up over here. All right, these are our long-term investments. And one of the things we'll notice is that plant and equipment rose from $1 million to $1,100,000. So we acquired another $100,000 in equipment. That's going to require cash. And I've covered this up, so let me uncover it a little bit. We also have investments, long-term investments, that have risen from $20,000 to $50,000. So we've made investments not only in plant and equipment, but also in some other investments, which we don't have detail as to what those are. But in any event, both of those are going to require cash. So to refresh us here, these long-term investment activities typically are in plant and equipment, and in this case we're seeing increases in plant and equipment, which is a use of funds, and we're also seeing increases in other investments. If we had decreases in these areas, those would be a source of funds. It's probably worth noting that the accumulated depreciation that we saw on the balance sheet, we're not going to use that at all for for this section of the cash flow statement, and the reason is accumulated depreciation, like depreciation, is not a cash flow at all. So depreciation we'll have to add back because it's in the income statement. The accumulated depreciation on the balance sheet we just ignore for this purpose. Let's look at the cash flows from financing activities next. Those cash flows are going to come from all of those items in the shareholders' equity section and long-term debt section. Essentially, as we've discussed before, the capital structure sections of the balance sheet, these are the providers of long-term capital for our firm. And to the extent that we are repaying some of that capital, either through repayments of debt or through dividends to our shareholders, that's going to be reflected in the cash flows from financing activities. To the extent we raise additional capital by issuing bonds or by issuing additional stock, that's also going to be reflected in the cash flows from operating activities. Again, let's look at back at our balance sheet. We're really looking at accounts that reside right here. So we observe that our bonds have gone up by $50,000. That means that we have raised $50,000 in additional capital. Preferred stock didn't change, or common stock didn't change. Capital in excess of par didn't change. Our retained earnings did. We're not going to use that retained earnings information. The retained earnings information is already, for the current period, is already embedded in this statement of cash flows because net income is embedded. Net income is where we start. So the thing we're really going to worry about here is this raising of additional capital right there, and then payments that were made to shareholders, which don't show up in the income statement. So here we combine all three of these. Let's look, though, first at this last piece, the cash flows from financing activities, and we see there the increase in bonds payable generated $50,000 in cash. We paid preferred stocks. We paid our preferred stockholders a dividend. We could find that back on the income statement below our income after tax, or earnings after tax. We also paid a dividend to our common stockholders of $50,000. So those three items are included in this cash flows from financing activities. So we've looked at each of these three independently. Before we move forward, let's just do a quick review of where the materials come from that show up here. I'll make a quick erasure. The adjustments that are made to the operating cash flows come from current assets, current liabilities. The adjustments that are made for the investing activities, the cash flows from investing activities, come from our long-term assets. And the adjustments that are made for our financing activities are all from the sources of long-term capital, be they long-term debt or shareholder equity accounts. And the shareholder equity accounts principally aren't reflected on the balance sheet. The things we care about for this purpose aren't reflected on the balance sheet for shareholders. They are the dividends that have been raised, although it's possible that we could raise additional stock or repurchase stock, in which case we would have to reflect that as well. So let's take a moment to consider our potential analysis of this overall statement. One of the things that we noticed was that there's been a purchase of $100,000 of additional plant and equipment, and a reasonable question that we might ask is, well, how are we going about financing those long-term assets? In this case, and this is in a sense preferable, most of the financing is coming from operating cash flows. We have $150,000 in operating cash flows that we saw in the first part of the statement. We also saw that bonds had been issued for $50,000. So most of this financing appears to be coming from operations and from the issuance of long-term debt, which is, we would prefer to see long-term debt perhaps than increases in short-term debt. And we do see that the accounts payable have risen fairly substantially, and if that were an expected source of funds for us on a continuing basis, that's likely to be difficult to sustain. Our suppliers are going to want to be paid, of course. So it's, in some cases, we might see firms that are funded with short-term debt for carrying long-term assets, but that creates a potentially high-risk situation. For example, if we're funding long-term assets with bank loans and the bank decides that credit needs to be tightened, we may find ourselves unable to roll over those bank loans, and we have assets that are long-term, but we find ourselves unable to get short-term financing when credit is tight, and we might have trouble generating long-term financing at that time. So what we've seen now is basically an overview of the statement of cash flows, how we construct that, starting at net income, adding back depreciation, and then making a number of adjustments to the statement for changes that occur in the balance sheet.